let's talk about the Dow hitting its ninth consecutive day of gains, marking its longest rally since September 2017 and the highest close for well over a year. The blue chip index benefiting from strong numbers at IBM and Johnson & Johnson. It's a different story for the NASDAQ, however. It slumped after Tesla and Netflix took the shine off of earnings seasons. Joining us now with some insight, Kevin Gordon, Charles Schwab, Senior Investment Strategist. So, Kevin, let's get into what's happening with the Dow. Is this bull durable?
It's starting to look more durable, and one of the things we've been looking for, especially because you've moved off of a major market low back in October, at least if you want to use the S&P 500 as the proxy, 9 months or so since that low. So you want to start looking for these confirmations, as we've been calling them, within the sort of below the surface of indexes. So number of companies making a new 52-week high. Is that pervasive? Starting to be pervasive in the S&P. Not as much NASDAQ, Russell 2000, or Dow, but it's a smaller, index of just 30. But that, along with what looks like small caps attempting to break out of kind of a range that they've been stuck in and surpass that early February high, has been an important marker, because you need to have that cyclical participation and not necessarily a complete passing off of leadership from the likes of the NASDAQ just to the Dow or just to the Russell. But as long as you broaden that net, we think that, that's a positive sign. That's a bullish sign of something that's a little bit more durable.
Yeah, and I was just looking at the S&P equal weight index, too, versus the S&P 500, which, of course, is market cap weighting.
Yep.
And it's been doing a little bit better on a relative basis as well. So the big test of whether we're going to broaden out should, in theory, be happening now, right? We're getting more and more companies reporting earnings. So is that going to be confirmed? Are we going to see the broadening?
If you do see it, I think you'll probably have to look a lot more below the surface, particularly like a day like yesterday. It's just one day, but I find the price action interesting, where you had outperformance from the Dow and you had a pretty significant sell-off in the NASDAQ or the NASDAQ 100. In our view, given the run-up that you've seen in the mega caps, whether you just want to keep it to the Magnificent Seven or if you want to keep it to the NASDAQ 100 itself, pull a little bit of a pullback, or just at least an easing in the acceleration that you've seen, at the same time that under the surface indexes like the equal weight S&P actually start to do better. That's probably the most benign scenario in the way that you can see more of a catch-up. So it's not going to feel as good from a headline index perspective because of the cap-weighted nature of indexes like the S&P or the NASDAQ. But you would want to look for more participation under the surface, and in our view, that would still be a more constructive sign.
Before we get to more talk about the Magnificent Seven and tech, so let's talk about a little bit about the banking sector. So the KBW Bank Index this week did have some strength in it. When we consider the banks in the larger context, they're kicking off earnings season, is the worst behind us in terms of the financials?
I think it depends on which part of banks you're looking at. So last Friday, a lot of excitement as larger banks kicked off earnings season because, results better than expected. You didn't really have any stress in that area as you did in the small and the mid-cap side of things for regional banks. And I think that split is probably going to be firm for a while. I mean, you can see the profitability headwinds for small and mid-sized regional lenders. It's pretty tough. And you're starting to see that come through earnings. If it's not deposit flight, that's the issue. It's the higher funding costs and the fact that they're going to struggle more from a profitability angle. So I think that the split between the outlook for maybe the next year, or at least the remainder of the year, probably favors large over small. And that fits a lot with what we've been saying in terms of a focus on quality. Because if you don't have a strong margin outlook, and if you haven't had strong margins in the past few months, probably not going to get rewarded as much in a stock price perspective.
So overall for earnings, FactSet is looking at a drop of about 7% for last quarter. Do you think things are going to be as bad as that? And of course, as always, people are focused as equally, if not more, on the outlooks. What do you think the tenor overall? I mean, we're maybe a quarter of the way through? We're not very far in,
right.
But what sense do you have?
Yeah, I think next week is probably more of a decisive week in terms of high-profile names, but a bigger chunk of the overall index in a market cap perspective as well. But I think it's going to be this mix of, do you have a similar scenario like Q1 where the bar was lowered a lot more in Q1 than it has been for Q2, but you had in Q1 this pretty miraculous jump back into no growth, which is actually good when you consider it, we were going into the quarter at down 5% for estimates. So if you don't get that kind of a trajectory in Q2 and you don't get a boost to guidance, or if you actually get cuts to guidance, which we've started to see, in our mind, that's probably a little bit more of a needle mover for stocks, at least to struggle a little bit in the second half. Not that everything has to go down, but I think directionally the rally has made sense year to date because forward earnings estimates have turned higher. So that's been a pretty key development in our view.